Hey everyone, it's Alex Morkate with Real Estate Shorts. In this episode, we're going to talk about the discount rate in commercial real estate. So in this episode, we're going to first define what it is in the context of real estate. We're going to define the various ways in which it's calculated or estimated, and then talk about how it gets applied in the real world. Let's get started. So first things first, what is a discount rate? So I think it's important to distinguish between kind of like the textbook definition and then the definition that gets applied outside of the classroom most frequently. So the textbook definition is the rate that you use to discount future cash flows to the present so that you can estimate a present value. Another way to describe it is that rate that gets used to discount future cash flows. Outside of the classroom, however, I think it's probably easiest to think about the discount rate as your required rate of return, or your hurdle rate, or your target rate. It goes by a couple different names, but I think the general principle is what is the amount that you need to earn on that investment. And I think if you think of it that way, it may be a bit more clear, but also it starts to open up the window into some of the different applications and certainly some of the different principles that are used to kind of apply and then estimate that discount rate. So first, I think the most important piece of the discount rate application is understanding that it is a measure of risk and return and the relationship between the two. So I'm sure you've taken a look at a property out in the market and you've said, you know what, this property is amazing. Tenancy is great, location is great, condition is great, market circumstances are great. You would imagine that there would be quite a bit of competition for that property. That competition may bid the price up because the perceived risk in that investment opportunity is relatively low. And I think it's that bidding up of that price relative to the same stream of income that ends up reducing the overall rate of return. I think the opposite is also true, where if you come into an opportunity and you say the tenancy is horrible, the market conditions are horrible, the property condition is horrible, then that implies a lot of risk. And if there's a lot of risk, you should be compensated appropriately for taking on that risk. So the more risk, the higher the required rate of return. The less risk, the less the required rate of return, or the lower the required rate of return. And I think this flows right into that concept of discount rate. The more risk implied in a deal or available in an opportunity, then the higher the discount rate should be to compensate you for taking on that risk. The more you discount, so the higher the discount rate, the lower the present value ends up being. And so I understand that this is a video that talks about discount rate in and of itself and not necessarily its implications on present value, but I think it's tough to talk about one without the other. So let's dive into a quick example so you can see how this relationship really plays out. So in this example, we've got a stream of cash flows starting in period one, split into two buckets. So the first is all the operating cash flows that you expect to receive, and then the next is the resale cash flow, so selling the property at the end of the 5th year. So in total, we're just summarizing all these cash flows together here in the bottom line for a total cash flow. Now, with a 15% discount rate, we have a present value of a hair under $1 million. Now watch what happens if we change this to 25%. Again, keep in mind, the higher the discount rate, the more you are discounting, so the lower the present value. So our $1 million present value, our $1 million value today changed to $688,000. The opposite is true. And so again, if we reset back to 15, what if it's a lower discount rate? Let's say 5%. We would expect the present value to be much higher because we're not discounting by as much. So we went from $1 million to almost 1.5. And again, I think it's this relationship that's important. It's not just that discounting more or less results in a lower or higher present value. I think it's also understanding why that happens in the real world. And so as we take a look at properties that have more risk, I think you should definitely get compensated for taking on more risk. As you take on more risk, you should earn more, and your required rate of return should be higher. All right, so moving on, how are discount rates calculated? So there's a handful of different ways, some of them very formal, some of them very informal, some of them sounding almost ridiculous. However, I think keep in mind that these are always going to be kind of anchored in that concept that this is your required rate of return. How much do you need to earn to get out of bed, to make this investment worthwhile, to make you feel comfortable for taking on risk? So the very first is, what do you want to earn? I think we need to start there. And once you've defined that question, let's find different answers for that question. So the first could be what's known as like the bottom-up approach, where you identify a risk-free rate, let's say a 10-year treasury or some other government-backed risk-free benchmark. And then you begin to add all these other risks to it. So let's say, for argument's sake, the risk-free rate is 1%. Then you can say the portion of risk attributable to lease and tenant is a certain amount. The portion of risk attributable to capital markets is a certain amount. Property condition is a certain amount, and so on and so on. And so as you begin to add on more risk, you begin to build up that discount rate. The challenge with this is that no one is ever going to agree, and many people are going to have difficulty quantifying what those individual risk premiums should be. So even though I think it makes a lot of sense in a textbook, it's very difficult to apply. The next is going to be comparables or competition. And so in the marketplace, if all of your neighbors, if all of your competitors in the marketplace have a discount rate of about 10%, then I think the extension here is maybe you should benchmark against them. The underlying assumption is that they are correct and that their assumptions and their risk profile is equivalent or similar to yours. I understand that that's a bit of a stretch, but I think this is another approach. The next is saying, let's take a look at the cap rate, because cap rate in and of itself is also this measure of risk and return relationship. So how about we start there? However, as you know, cap rate is really just a snapshot picture in time. It is today or 1 year ahead. It doesn't necessarily account for all the future growth or appreciation you can come to expect in owning a property. So how about we take cap rate plus that expected or anticipated growth rate? The combination of the two could be a proxy for discount rate. The last is simply to pick 10%. I understand that that feels so outlandish that you shouldn't apply it, but I think as of late, the discount rate has hovered between 8 and 12% for most properties across most investors, across most institutionalized markets. So if you kind of start at 10% and then begin to adjust your way up or down, there may be some merits in applying this approach. So as we begin to kind of wind down, there's a handful of applications of the discount rate in practice in real estate. So I think the first and foremost is going to be, how do you define the most that you're willing to pay? So what is the real value of this property? So if you believe the property, based on its stream of cash flows, is worth $1 million, you can use present value and the discounting process to help you arrive at that estimate or conclusion. I think by extension, if we begin to talk about partnerships or leverage, you can begin to estimate the value of an equity component or partnership stake in much the same way. It's also possible for you to use this as a benchmark or point of comparison. So if the property earns or generates 15% return and your discount rate, your required rate, was 10%, now you can begin to compare and contrast alternatives. Say, this project is acceptable because it exceeds my requirement, and this project is not because it doesn't. So again, in other words, if you identify 3 investment options, some have a IRR or return that's higher than your discount rate, those may be acceptable investments. Those that are below the discount rate may not be. I qualify may and may not because there's a lot of other factors that go into deciding if you want to actually invest, but this could be one of those starting points. As always, the higher the discount rate, the lower the value, and the inverse is true. So just keep that point in mind. The more you discount, the lower the present value. So as we begin to kind of recap here, discount rate is one of these cornerstone topics in finance and certainly in real estate. There's a handful of different ways in which we can calculate it. The most prevalent are likely going to be some combination of the ones that we've mentioned. So we could say starting at 10%, reflecting on the cap rate and the anticipated growth, surveying the market, and then performing a gut check against the risk-free rate plus all the premiums associated with the risk inherent in that property. It gets applied most consistently in real estate as either a benchmarking tool for performance or for establishing what the purchase price or maximum offer price should be. So if you found this video helpful, I'd encourage you to take a look at a handful of others like present value, like future value, like some of the other time value of money concepts. And as always, if you have any questions, look forward to hearing from you. Thanks again. See you soon.